When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events, cash flow or income, which is more important in retirement. We'll answer some listener questions for you, and also, you always have to sacrifice growth for safety in retirement. We'll give you our opinion on that. My name is Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom and solid advice, of course, you know they come from the other Jeff. It's going to be Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
Doing great. How are you doing?
I'm doing fantastic. Thank you. Always glad to be with you and the fine people here in the greater Tucson area. We appreciate you making us a part of your weekend here on 790 KNST. Let's talk about what's going on in current events today. Jeff, I saw that President Trump had a 53% approval rating among the populace, according to some rather liberal sources. Do you think that the 53% approval rating is accurate, or do you think it could be actually more? And how do you feel about how things are going?
Well, I think it's probably a lot more than that. I mean, anything you get on the news of Fox is probably slanted the other way if they, had a slant. But, most of the news media, especially CNN, or I think I saw that the same poll, and, the more liberal networks, I think they're trying to come around to, report things that are okay and make them not look so left-leaning. I mean, left-leaning, like off the cliff left-leaning.
Right.
And to actually report some things that are, in a little favorable about Trump, where they don't get ostracized from every viewer of the nation because of the BS. But I think it's probably higher than that. The thing is I'm glad that they kind of came to the party and says, whoa, hey, America seems to like what's going on here. I think 70% of the viewers, based on that same poll, I think said that they believe that he was doing what he was elected to do and what he promised. He's keeping his promises. That's pretty high numbers. He said he would come in and do those things. What I think is really odd is how much pushback they're getting from the Democratic Party. I mean, he's doing good things, and they're coming in and says, we got to stop him from doing all this. We're trying to save the American family and save the people. No, the American family voted you out and voted him in to do the things that he's doing. I mean, to have a court, stop Elon Musk or any appointee of the president to look into the Treasury, to say nobody can look at the Treasury records. Well, who gets to then? None of those people that are in the IRS are elected, they're appointed. They do have committees that are, oversight committees and things like that congressmen and, senators belong on and work on as far as to give advice and to come up with bills and laws. But as far as who audits the government, well, so far, nobody has been auditing the government. It's supposed to be done by Congress, but of course they've been, skimming the cream off the top and redirecting all those funds to whoever they want to. It's cronyism and, payback time for all the votes that, got them in, and, all the shenanigans that they've been playing for years. So they're finally getting caught and they're freaking out. I think the news got it right, at least to come out and tell the truth that, hey, our side lost the election, but dang, people seem to be happy with what's going on. And, aside from that, they are happy with what's going on. That doesn't mean that we're not in such a bad shape that, we're going to avoid any chance of recession and the market's going to go to the moon and all these type of things, where I think there's a little bit too much rosy sentiment that we need to be a little bit cautious about. However, I think the reports are right. So far, in 3 weeks or 4 weeks, or been about a month, I guess, we're seeing really good things. And we're seeing what I think the people should expect out of their government. And that is some oversight and some transparency and clear information. Of course, the other side keeps saying that it's BS and they really didn't use FEMA money to, house illegals, and they really didn't redirect money and violate the executive orders to not spend. And they're BS. And I mean, yeah, it's the other side trying to save face and trying to say, no, we didn't. It's a foul. It's not us, when in fact, it's obvious that it is. So I don't know how they're going to climb out of that hole. I think there's got to be a day of reckoning come. And it's not just the Democrats. I think there's going to be enough pushback even on the Republican side, because there's plenty of hands in the pot and they're not just partisan. It's a bipartisan problem, I think. However, the last regime that was in play, I think, abused it to the max and to extents that we've never seen before. And I think that's going to come out. So, when you find out Chelsea Clinton's got $85 million from, that U.S. aid and done very little with it, which means most of it's in her, built her net worth because she was Clinton. But has she actually done anything as far as noteworthy, or just, sat at the head of some charity that redirects government taxpayer money? I mean, she doesn't have to go and do fundraising. She just gets all these grants and monies to do fake things that look like benevolent things. And I'm just singling her out because she got, she's in the news. So many people have heard about, but it's not just her. It's a lot of people. And it's a lot of people, politically motivated by people that got elected, and, they're putting their friends and their donors in positions to reap the benefits of taxpayers' money without any accountability to it. And I think it's ridiculous. So, that's the biggest thing I think that Trump's doing that people love, and that, the fact that he wants to, bring America jobs back. I think the jury's still out on the tariffs, and the jury's still out on, how the budget's going to actually balance out to where we can save Social Security, save Medicare, have a robust economy, and not go through some major recession and a reset period. But right now, none of the bad things have happened, and all the good things seem to be finding their way to, be in place. So I'm optimistic. I like what we're seeing. I like the optimism of the public when it comes to money and finances and market. We can talk about this a little bit more later in more detail, but I still think we need to be cautious about that, because insider money, insiders meaning CEOs, the C-level executives of companies, are selling at higher levels than before. Hedge funds are selling at higher levels before. Institutions are selling at higher levels than before. But it's the street, the main street, the less informed, the non-sophisticated investors that get their stock tips from CNBC, which is just an entertainment show with Jim Cramer or whoever, or Motley Fool that tells you what to buy after they've already bought and sold it, or some other source that really isn't based on any type of fundamentals, technical trading, momentum, volume, all the different things that somebody who's actually looking at long-term investments and the interest in the stock market would see. And what we're seeing is it's the private household, the private investor that is getting enamored by Trump's election and letting it spill over to the market. And I think that's where we need to take a little bit of caution and double check. Now, I still think there's great opportunities, and I have a lot more confidence in the market right now too, but I don't want to do it to the detriment of being careless about it or just assuming that nothing bad can happen, because the market giveth and the market taketh away. It's not a one direction game. And although Trump, I think, will fix a lot of the problems that made these valuations unjustifiable, I think he'll make some of these valuations of the market a little bit more justifiable over time. I just don't know what's going to happen between now and then.
Jeff, you talked about money and the market and just the entire financial landscape. How has that reacted to Trump's presidency so far? And are we anticipating that it will continue to react the same way here for the rest of the year?
Historically, we have usually once the election's over, the next year is typically a good year, at least a positive year. It could range anywhere from a few points to double-digit increases. However, the year of the election typically is kind of iffy. It's typically bad in the beginning. It gets a little bit better once we know who's going to win the election. But we had no clue right up until the election this year. And the Fed just kept on pumping money to banks, and they kept on buying stock, and everybody's telling everybody to buy stocks, and they're going up, and everybody's on this addictive high of making money, kind of like a drug addiction. And the market way overperformed the year before the election. So, it could happen that we got this year's gains last year, and we need to have kind of a pause in the upside of the market. However, many of the policies that Trump is talking about, like energy growth, the fact that he wants to support everything, reduce regulations on, drilling and things like that, so we can create enough energy to power this big system that needs a lot of electricity. They talked about data mining for crypto took a lot of energy. Well, you talk about AI and the type of power it takes to run those chips, and the type of power it takes to run the cooling machines to cool those chips, and all the different things that go into that. We need more than just drill, baby, drill oil. We need a lot of nuclear. Nuclear is making a comeback like it's never made before. It's going crazy. The thing is a lot of these companies already have earnings where their price earnings ratios are reasonable, especially in light of the growth that's ahead of them. So I think there's some industries and there's some sectors of the market that will prove to be the right place to be at this time because of the policies that Trump is making. But with that said, there's a lot of companies that are failing. I mean, if we look at just the last week or two, we've seen the Magnificent Seven actually choppy and going down. I think Meta is about the only stock out of the seven that is, hanging in there. We had a drop of over 20% with NVIDIA. We've had Microsoft get hit pretty hard. Apple, Google's been choppy. Amazon lost a bunch of money. We've had a lot of those big sector stocks, and Tesla falling like a rock. It was over 400 and it's low 300s now. So it's gone down 20+%. I shorted that stock a couple of times last week and made money. So, these stocks that have carried the S&P are not looking strong. They're looking really weak right now. And it's not necessarily because of Trump. It's just because they were so overvalued. I think it's coming back to a reality in those sectors that still have some growth left. There's going to be room for a lot more competition. And with that said, does it look rosy? Well, yeah, but there's still of the factors that I've been talking about for the last 2 years. And there's a cycle, a lot of cycles that culminate in recession that I don't know if Trump's policies can overcome. One is the yield curve inversion. I've talked about this about 2.5 years ago. I started talking about when the yield curve, in other words, the short-term interest rates get higher than the long-term interest rates, which happened when Powell was starting to raise interest rates in order to combat the inflation problem. It started really heavy in 2022 and carried us into 23 and 4. But now inflation is not really that under control. They've been lowering the short-term interest rate again, and at the same time selling bonds, which makes the bond prices go down, which has normalized the yield curve. So now you've got 10 and 20-year bond rates, pushing 5% or well over 4% anyway. And, the short-term rate, which used to be 5% plus, is now under 5% and it's going down. So, we've had this kind of a freaky anomaly, although 30 months after the inversion started, which is the longest period of time that it inverted, meaning short-term rates went higher than the long-term rates, which is kind of, an unusual situation. Usually time is a factor that you make a little bit more money if you're willing to lock up your money on a bond longer period, but it was flipped. So up till now, that cycle has always ended in less than 2 years. And that's why I think 6 months ago or so, everybody's saying, well, hey, it didn't happen in 2 years. This time it really is different. Well, according to John Templeton, who's been gone a long time, but a guy that said some very poignant things and ran a mutual fund company, Templeton Funds, for years and was very respected, like John Bogle, who set up Vanguard, like Warren Buffett, those type of guys. And he said the most dangerous words in the market are it's different this time. And, I think people have thought that, well, it's different this time. We're going to have a soft landing. The yield curve's not uninverting. Guess what? It did in January. That was a month ago. So what happens is every time the yield curve uninverts, or every time we've had a recession, it's after the yield curve uninverts, and it's usually a month to 6 months later. So, we're in that period of time where historically that can happen. The other thing is, I've talked about this before, is you've got the private households are getting so enamored with AI and the stock and the hype that they're hearing on TV, while Warren Buffett is raising almost $1 trillion out of his $3 trillion company, which is, Berkshire Hathaway. You're looking at a third in cash. Why? Because he thinks he can get a better buy in the future. You've got CEOs, C-level execs selling their stock. You've got hedge fund managers and banks selling their own stock, selling into all this hype. And it's the private households that are buying the stock based on just the good lovey-dovey, hunky-dory, happy feelings that they're getting because the election's over or because they're hearing on TV that they should buy and the stock's going up, so they might as well jump on the train. But if that train's heading off a cliff or going to be derailed soon, they're not looking for the obstacles up ahead. They're just looking at this train's going fast and we want to jump on. And when that happens, when private ownership gets over 60%, which it is right now, where private household ownership is over 60%, every time that's happened, and the highest times it's ever happened where it's been over 60% was in 1929 and 2000. They were, the private sector was buying so much stock in the roaring 20s because, it couldn't go down. It was never going to go down and it can never correct because we were in new times. Did it again with the dot-coms. It bombed and everybody lost, who was in the market, lost, half to 3/4 of their money or more. That's why, because they were just getting too complacent and too carefree and careless. And that's exactly where we are in the cycle right now. We're over 60% private households. We're at a point where the market's kind of showing a peaking. And we're showing this complacency stage, this euphoric stage where we buy everything just to buy everything. We've got other factors that also correlate with recessions. And that is, and again, I'm not here doom and gloom. I am really happy that Trump won. And I think what is historically likely to happen will be, the effects should be minimal compared to what it would have been had the other side won. I mean, big time. However, I don't think, Trump is magic. And I don't think he's got a big enough shovel to dig us out of the hole that has been dug. And history tells us that we need to be cautious still, although we can have a little bit more confidence in certain areas of the market that are going to definitely benefit by Trump's presidency. That doesn't mean there can't be a sell-off, and it doesn't mean you can't lose money. You still need to be very cautious while we dabble back into the market. A couple other things that we have to acknowledge is that savings is at its lowest point ever. Delinquencies and loan delinquencies are at a high point. Credit card delinquencies are at a high point. Credit cards are loaded up to buy household products. I mean, people are borrowing money against their house and borrowing money against their credit cards to put in the stock market. That stuff happens before bad times happen. I mean, that's the preceding events to historically our market crashes. So I think we still need to be cautious. As optimistic as I am about our new presidency and about the job they're doing, I know they're going to have opposition from every turn from the Democratic Party. They're going to have opposition even from the courts. I mean, telling them they can't look at records that they have a right to look at because their job is to make sure that they're good stewards over taxpayers' money, yet they can't look at it and see where it's being thrown out or where it was spent. I mean, how is that even possible that could happen in America, where a judge would actually say, oh, you can't look at records, or, hey, you can't appoint somebody to audit, the shenanigans that the politicians have done over the past several years. I think it's time that we do that. We need a revamp in government. We need a reset. We need to believe that there's some sort of sense of honesty and integrity with those people that we elect to go to those offices that represent us. And I don't think most Americans have had that. But I think we're starting to feel it now. And that's why Trump's ratings are over 50% right away, right out of the gate, higher than it was his first term and higher than I think any president in their first few weeks have been in a long time.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about the approval rating that Donald Trump has, 53% right now from some liberal media, probably more. And of course, we're talking about the Trump presidency here. It's going to be a month old pretty soon and how that has affected the market and the economy. We're going to continue this conversation in just a moment. But in the meantime, you're listening to the program today and you are in tune with what Jeff is talking about. You'd like to sit down with Jeff and talk about your individual situation towards a confident retirement. You've got questions. Jeff has answers for you. Our telephone number, 520-780-9059. You can make that call this weekend right now. Leave your name, number, and Shelley will call you back during the week and set up an appointment for you to sit down with Jeff. Have a very casual conversation about anything that you want the answers for to help you with your retirement. By the way, a retirement that could last as long as 30 years or more. So take advantage of this opportunity. There is no cost, no obligation whatsoever for this. Again, a casual conversation. 520-780-9059. You can also find out more about us and contact us from the website, which is premret.com, premret.com. Jeff, something else that President Trump has done, which I think is long overdue, he's ordered the U.S. Treasury to stop minting pennies. I understand that it cost about 2, maybe close to 3 cents to mint a penny. What do you think about, making the penny go the way of the dinosaur?
Well, I mean, I get the idea of getting rid of a penny. However, I also get the idea that, how do you give change? I know in a credit card, you can deal with pennies and it's just an electronic number anyway. The other thing, I'm not really, do we just round up to a nickel if you have something cost you $1.26? They can't really give you 74 cents back. They just give you 3/4 and call it good. Maybe that's no big deal if the stores round up or down, maybe, or they just always round up. Then they just have to remember that's part of the deal on change. Or maybe you have to round up. If you're paying cash, you're going to round up. I don't know if the store rounds up or the client rounds up, but one of you is going to have to round up if they price everything in pennies. But if they don't, then they can just price everything in 5 cents and round the tax to a 5 cent. I don't think it's a big deal if it saves that many billions of dollars to taxpayers' money, if they're really making that many pennies. But the thing is that penny gets used hundreds and thousands of times before it gets lost or, put on a railroad track and smashed for a souvenir or, just lost in the dirt in the backyard, or somebody says, oh, I like this penny. I'm going to collect the San Francisco 1994 pennies. I'm going to take it out and put it in my collection or whatever. They do end up falling out of circulation. I can't remember the number, but there's a lot of pennies out in there in circulation.
I'm looking at right now, Jeff, if you're thinking about collecting pennies, consider there are 114 billion pennies in circulation right now. Yeah. I think half of them are in the, between the seats in my car too.
They just kind of go missing. So I don't know that it's a big deal. If 114 billion times 2 cents is, what, 100th of that is like $1 billion or $2 or $3 billion that they've spent. Yeah. I guess it is. In the context of the government, is it? I don't know. To keep a monetary system that, makes sense. I've gone to Mexico and they've got centavos and stuff still when, they're just like almost worthless. When you look at what they actually buy, you have to have a whole bunch of them to make anything of it. And, that could happen, I guess, if we just keep using pennies. I think they're probably going to try to eventually roll to a digital currency where everything's like a credit card and just everything's done electronically. Some people talk about putting a chip in your hand, so you always have your ID and your money on you. I think that's kind of a little futuristic still, but probably not that far away if we think about how fast technology moves and how fast we do things. So I think there's probably going to become a time when cash and coins of all types start becoming obsolete. Why not start with a penny if that's really the direction we're going to go? Honestly, it doesn't bother me one way or the other. I just think if it costs 2 pennies to make a penny, is it really the penny that makes it worth it to have a penny, or is it really what it represents? And it represents commerce and the ability to buy things and trade and do things on an exact basis based on, the percentages of tax and different things that make something that's priced at $1.05 really come out $1.27. There needs to be some pennies. Or do we just say all the taxes are either 5 or 10%, so it never comes out a penny?
I have gone to pretty much using digital currency. I use my debit card for pretty much everything, even if it's $1.50 Diet Coke at the drive-thru or something like that. I carry very little cash, but I will say that the middle of my car has quite a few pennies in it. The other thing that I think Donald Trump is doing, which I say hooray to, it's not as important, I guess, but I'm all for these plastic straws coming back.
Me too.
You ever try to stick a paper straw through that little hole in the plastic top of your cup? It just doesn't work at all.
And it breaks.
Yeah, so, hey, listen, pennies go away, plastic straws, let's bring them back. These are the important things we got to worry about here. And Donald Trump is certainly doing his job on some more important fronts. Once again, you're listening to the program today. You're listening to Jeff, and you're saying to yourself, this guy makes a lot of sense. What he's talking about really resonates with my values, my goals, and also he's a really smart guy. I can attest to that. You want to get in and sit down with Jeff, have a casual conversation about how the market, the economy will affect your portfolio. Maybe you feel that your plan is incomplete. Maybe you've gotten a cookie cutter plan from another financial advisor. You want to have a second look at this, a second opinion, if you will. We would invite you to call us this weekend, 520-780-9059, and request your no-cost, no-obligation Premier Retirement Review. We call it the Retirement Roadmap. Again, no cost, no obligation for this. Certainly there is no judgment. Again, call that number today. Leave your name and telephone number. Shelley will give you a casual call back during the week and find a time that is convenient for you to talk to Jeff. And again, it's not going to cost you a dime. 520-780-9059 is our telephone number. You can also find out more about us online at premret.com. That is PREMRET.com. Jeff, time for a break. When we come back here on Premier Retirement, we'll be answering listener questions, and we'll get to the other topics here. Cash flow or income, which is more important? And you always have to sacrifice growth for safety in retirement. When our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We are so grateful you decided to join us here for this weekend's Premier Retirement with Jeff Hogan on 790 KNST. And again, we are on for you 4 times a week. Doesn't make any difference when you're listening to us, whether it's Saturdays at 7 a.m., 9 a.m., or 1 p.m., or Sundays at 11 a.m. If you have missed any part of the program, you'd like to hear it all over again, we're also a podcast. Go to wherever you get your podcast and look for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Okay, Jeff, time for listener questions. The first one is Greg listening to us in Green Valley. Greg says, I'm 64 and 3 years away from when I want to retire, so that would be age 67. My portfolio is 100% in equities. How should my portfolio change as I approach retirement and then on through retirement?
Well, I think all equities is great if you're dollar cost averaging, just working and putting away, and you've got, 20 or 30 years of work to just store up as much cash as you want. It's a great wealth building tool as a stock market, and especially when you're doing it consistently. It looks like you probably have, but 100% in equities. I don't mind you not being in bonds for sure, because bonds are still weak. Fed's selling them, making the price go down. I mean, the fact that you haven't had bonds means you haven't taken the shorts on a big portion of your portfolio. The market has been very good. I believe it's, and you heard me talk before, it's been pretty manipulated to the upside, and it's pretty much out of control, but it's been manipulated. I say that because of just the money printing that's been going on. And, even when the Fed says that they're going to tighten money policy, they're still handing money off to the banks and not making them pay back, bad debt that they took away from the banks and said, oh, don't worry, you don't have to, pay this back now, just keep the money and, invest it. Well, banks, which are the same as the brokerage firms, have been buying up the market. So we've had a great run. One of the things I learned when I was a stockbroker is you never get hurt taking profits. And if you've got profits, and I don't know how big your portfolio is, I mean, if you've got $100,000 and, it's a play money, then keep it. You might have a big pension from someplace. But if you've got, $1 million or $2 million saved up in equities and you need to use that for retirement, you're planning on making $100,000 a year withdrawals from that account, You might be really surprised when the market tanks the next time and you're spending money that's going down in value, and that money doesn't have a chance to ever recoup or come back. You'll run out of money in the next couple of crashes if that happens. So, my opinion would be to find out what your basic income needs are. And if it happens to be $100,000, then you take your Social Security and any other fixed income and what the difference is between that 100 you need, and say, okay, how much of this $1 million or whatever it is that I have saved in my 401k and other retirement assets, how much do I need to set aside that will guarantee me payments like a pension that will guarantee that I never have less than 100 grand. And then I still have money to invest that if it goes down, I'm still paying my bills. And I just have to be careful about, what I touch when the market's down. Or you could say, you know what, I've done really well in the market. I don't want to take any more losses at all. If I don't lose any money, I have plenty to live on through all my retirement years and still have plenty of inflation protection because I've got extra money and far more saved up than I need to live on. Depending on what situation you're in would dictate how much you'd want to move to something that created income. You might also, depending on if this is all qualified or IRA/401k money, or if it's Roth money, which isn't taxed, or if it's non-IRA money, which you've saved up, maybe sold some rental properties or did some things and, invested in the market outside of a 401k, you might want to reposition some of that money into a life insurance shell. A lot of people say, like, why would I do that? Dave Ramsey, all these other guys on the radio say, don't do life insurance. Well, life insurance has a lot of tax benefits. They call it the rich man's Roth for a reason. You can actually purchase life insurance and borrow against your death benefit essentially throughout the remainder of your life. Your death benefit is tax-free. So if you borrow against that death benefit that's tax-free, when you die, the death benefit just pays off everything you've used throughout your life, plus the interest that's accrued. And, if everything works out as it has historically, you make the same or more on your money, on a bigger amount of money that you put into what I call a LIRP, life insurance retirement plan, over the years, and you will be able to use that money tax-free. The cool thing is you don't have to declare that as provisional income because it's a loan against a life insurance policy. You can live on that the same as you could live on the equity in your house and not call it income, and utilize some of those assets that you put away for your future and not have to pay taxes on them, not have to declare them as income, not have your Social Security tax at a higher rate, or not have to pay more for your Medicare like so many people do who basically, sock away a ton of money in their 401ks and IRAs. And then when they have to pull it out later, they end up having to pay more for their Medicare because all that comes on their tax returns as income, whether they need to use it or not. The other thing you might want to consider is, indexed annuities, which guarantee income, guarantee lifetime income. You said you're 64. I mean, that would give you probably, if you retire in 3 years, let's just say you put $1 million just for a round number in something with an income rider, you would get somewhere in the neighborhood of $75,000 or better per year. That would be a guaranteed that the insurance company who offers this product knows that they're going to make enough on your money that you're not going to run out of money. And if you do, they've got a slush fund built up that they can pay you if you outlive your account. And if you don't outlive your account, guess what? The remainder of that account goes to your spouse, your kids, or your heirs, whoever they might be. And if they are in need of income, they can use it for income, or they can just cash it out and move on their merry way and pay off some bills or go buy a car or a house or whatever. So there's a lot of options that you can use to make your future a little bit more secure if it isn't. Again, if your future's secure and you've got more income than you need to live on because you're a responsible saver, because you have, great pensions, maybe you were in the military and have 3 extra civil service job pensions coming in, and you've got $240,000 a year coming in that you can't spend now. I have a couple of clients in that boat. And if you've got a few $100,000 in the market and it's all in equities, sure, have it in equities. It doesn't matter if you lost money. So again, it kind of depends on where you're at, if you can afford to lose. We call the 5 years before retirement the red zone because there's no guarantee that the market's going to be as high 5 years from now as it is right now, especially if we're at an unprecedented valuation where it's at its all-time high or close to it based on the dot-com valuations, the 1929 valuations, and it's even higher than it was in 2008 when the market crashed. So if we use history as our guide, this is probably not the greatest time to get into the market or to put money that you might need to use in the next 5 to 10 years. It's a great time, however, to take profits and to lock in all that savings and all those market blessings that you've received in the stock market by investing there in equities, and take advantage of that great growth and lock up a nice, happy, fat retirement income for yourself, and then keep the rest in the market or in a diversified portfolio of things that might be a little bit more interesting. The other thing is there are some securities, and you might have them, that are really high dividend type stocks or ETF, exchange traded funds. You might want to gravitate toward a few of those. They still have upside potential from the standpoint of growth, but they also pay out a nice dividend where you can get some some generally guaranteed or at least predictable income from those things. Now, keep in mind, anything that pays a dividend can change that dividend anytime. They're not guaranteed. So if you want guaranteed income, go with the annuities. If you want predictable income on a tax benefited basis, go with the LERP. If you want sort of predictable income, then keep it in the market. Just be careful on how much you use.
Craig, thanks for listening to us there in Green Valley. And of course, we'll send you out Jeff's book, Retirement: The Road Ahead. If you want to have a further conversation with Jeff, call 520-780-9059. The phone lines are open right now in order to do that. Next question is Jay in Vail. Jeff, Jay really has a two-part question. Number one, is it still advantageous to have a financial advisor versus using an adjustable target fund that most employers offer? For me, adjustable means while I know I'll retire in 10 years, I may opt to set my retirement out 15 years, allowing me to be more aggressive with my portfolio. In this scenario, I'm not monitoring or adjusting my portfolio frequently. Second question is, what's the benefit of having a financial advisor like a CFP or a CRPC that charges a flat fee of 1%? What's the benefit of having an advisor that offers a fee-only service? While I enjoy the quarterly review of my portfolio with my advisor, and together we tweak funds based on goals, I'm trying to understand whether I'd benefit more from a fee-based or fee-only advisor. Is one type of advisor better than another? I don't want to leave money on the table come retirement time. So, two-part question there.
Well, I mean, if you're a do-it-yourself or you don't need an advisor, if you just want to do something that's automated and you're happy with it, I call people who just hate paying fees fee weenies. I mean, if you get a value by paying a fee, pay a fee. I think what we provide by a fee, and by the way, we don't charge fees on all the investments, just the stuff we manage, but, the people get a really good return on their investment, in my opinion, for 1% or, whatever it is, wherever you go, you have to find out, am I getting something for it? I know that I can do tax planning that'll save people maybe 5 or 10% per year in their taxes in the future. I mean, that goes a long way to cover the fees that we would charge just by adding tax planning to the mix, even if we don't beat the market or what they could do on their own. However, we may not beat the market, but we might give you a smoother ride. If the market goes down 50 and we only go down 8, but if the market goes up 20 and we still go up 12, you're still better off in that scenario if you look at the overall total return and where you are in a couple of years on that market swing. Do you want a smooth ride? Do you want an advisor that you can bounce ideas off of? Do you like somebody that you can talk to about your taxes, your estate plan, your will, or your trust? What about your Medicare plans? Not hitting your IRMA levels, or, how much you can put in a Roth, and is it wise to do a Roth conversion? I mean, that advice is probably worth something. If it's just a matter of you're going to do everything yourself anyway, not bug your advisor and not ask him any questions because you don't have any or because you're very astute and savvy, then I wouldn't pay a fee to anybody. I would just do your own research. But one thing, I don't really like those target funds, those adjustable type employer funds. Honestly, they're the worst performing, and typically I don't think they're really managed. They're just kind of a sector. Let's just throw something at an index and balance it and see what happens. Interestingly, the ones that are closest to retirement have more bonds in them, and bonds have been getting hammered lately for the last 3 years. So, people that have a quicker route to retirement are actually losing money when the people that, are 15 years away from retirement, like you might be, can stand to ride the roller coaster and be more involved in a higher risk portfolio, which in that case, that type of an employer plan was probably skewed more to the market. But then again, that could also lose more money, given a bad market year or some black swan events, or who knows, a war breaks out, or this massive layoffs in government work and create such unemployment that we can't dig out of the jobs, and the unemployment, it doesn't keep up, and we have a big recession and the market crash as well. Maybe losing 20% on the bond section of your portfolio is still better than losing 50% on the stocks, but the stock portion is still going to lose money. So, I think you need to realize that whatever you're in that retirement fund, stocks and bonds both can lose money in a bad market or in just the wrong scenario. So, whether you have 5 years or 3 years, 10 years or 15 years to retirement, I think you need to understand your risk and understand what you're getting into. I think it's only been recently that people finally starting to understand that bonds have risk. They don't understand why their portfolios are still down after 3 years if they're in a 50-50 bond stock split and they haven't made any money. Well, it's because the stock market, crashed and the bond market crashed. Stock market came back on that half of the money, but the bonds haven't. So, maybe now you're back to even and wondering, why is the market up and I'm not? Well, bonds have risk too. So, those target funds that only have stocks and bonds, I don't know will satisfy the whole demand of your retirement plan. But, when you have a 5-pillar plan or a 5-part plan where we talk about your investments being appropriate for risk, appropriate for, creating income at the particular time that you don't have a paycheck and you need income, tax benefits, that the taxes, you don't go in a new tax bracket when you retire because you have to start taking required minimum distributions in your 70s, or because you have to start living on IRA money that's 100% taxable, as opposed to maybe converting some to a Roth or using LERPs or other tax-free income sources. There's a whole lot of things that could go into the mix. Also, where are you going to hear about index annuities? You're not going to hear about that at your broker or your 401k. They don't offer them. All they offer is typically stocks and bond portfolios. So, if you want to know what's available to you out in the world, I think an advisor is invaluable. And the percentage you pay on some managed account might be a drop in the bucket, compared to the benefit you get on peace of mind, guaranteed income, and in some cases, growth. There are times when we're aggressive in the market, we beat the market. There are times that we are less aggressive, we don't lose as much as the market. Is that worth 1%? Maybe. Our job the last couple of years is, for most of our clients who are getting ready to retire, a little closer to retirement than you, would be, let's not go into risk when there's a good probability that we're right at the precipice of a cliff. However, if you got 10 or 15 years, then, hey, keep investing in those longer term investments. And if you think you're too young for an advisor, maybe that's what you keep doing, is just, when you get maybe closer, like 5 years from retirement, maybe that's when you take on an advisor to learn about repositioning some assets into some of these different accounts. However, I don't think waiting is advantageous to you. I'm just saying you might want to just keep doing what you're doing until you get a little closer to retirement, and then, think, okay, now I need to know what those safe opportunities are. However, if you're in a position to allocate some funds towards some of those insured and secured asset classes that can guarantee you income 10 or 15 years down the road, where the things that you're investing in right now don't guarantee any income, then you might want to consider starting earlier on some of those plans, because they're a lot easier to get into early than they are to try to make up ground late.
Jay, thanks for that question. If you'd like to have a further conversation with Jeff about this topic, 520-780-9059. Make that call today. We appreciate you listening to us in Vail. We'll send you out Jeff's book, Retirement: The Road Ahead. Next question, Jeff, is Patty listening to us in Tucson. Patty says, I'm semi-retired and manage our rental properties, but I am slowly selling them and planning to sell the last one in 26 or 27. Between profits from selling our rentals, our stock portfolio, and our 401ks and IRAs, we'll have about $3 million with a paid-off home. We're 85% in stocks and invest moderately aggressively. Our funds and our tech stocks have done well over the years. My husband doesn't want to retire until he's 70, which is 14 years from now. My question is it still okay to invest this aggressively for the next 10 years?
Well, I think it doesn't sound like you need money. It sounds like you're pretty well heeled from the standpoint of, sales of the property and all those things. If you look forward and say, well, $3 million could be worth half that amount 5 years from now or the next few years, and do I still have enough time to recover? Yeah, probably. I think you'll still have, 14 years from now, I would be really hard pressed to believe that you'd have less than $3 million if you left it in the market. However, you could redirect maybe a third of it into something that you can guarantee predictable income that could be turned on at any time in case your husband decides he doesn't want to work till he's 70, or he has some sort of a health issue in the mid 60s and he has to retire earlier, and it happens to be when the market's down. So you might want to take some of that profit off the table, not be as aggressive, and set up something that will guarantee you some great returns and some future income should you need it. And also, what about sheltering some of those assets that you just had to pay taxes on by selling the rentals or stock portfolio? You had to pay capital gains on them. What if you put them in something that you never had to pay taxes on again, and you had like a tax-free bank account that would be worth $1 million or $2 million that you could draw out of anytime you needed, and it wouldn't put you in a new tax bracket, or it wouldn't, issue a 1099. Basically, we're talking about, stealth money in retirement. That's what a lot of my real estate clients or past real estate clients do, is they put that money because they don't really want to be a landlord going into retirement anymore. They've already done that and done all the work. They've created great profits, paid taxes at a capital gains rate to get out, which is way cheap compared to what the ordinary income on that money would have generated, or what it would have been taxed at if you took it from an IRA or 401k. So, let's count your blessings that you paid lower taxes than you would have otherwise on ordinary income. And now you can reinvest it in something that doesn't have a tax ramification at all and never has a tax report. You just get to use that money at will. It continues to grow at a competitive rate, and it's all tax-free, not just to you during your lifetime. It's also tax-free to your heirs when you pass away. And if you have a big enough estate, you can even make it tax-free on an estate tax basis if you think that's going to be a problem. And based on $3 million at this point, may or may not be a problem, but we can look ahead and do some projections that would give us a better idea of how to reposition your money to moderate those tax consequences in the future.
Patty, thanks for that question. And of course, for listening to us in Tucson. Again, if you want to have a further conversation with Jeff about this topic, 520-780-9059 is our telephone number. If you want, you can call that number right now. Leave your name, telephone number, and Shelley will call you back during the week and set up a time for you to sit down with Jeff and ask further questions. And if anyone listening to the program today wants to submit a question, you can do that by calling it into Shelley, 520-780-9059, or you can go to our website, premret.com, and you can put it into the contact page there. If we use it on the air, of course, not only will you get a great answer, but we'll also send you out Jeff's book, Retirement, The Road Ahead. Jeff, we all know how important income is in retirement, but also cash flow is something that we should consider. And of course, income is the money that you've got going in, but cash flow is a combination of the income and the outgo. So if I were to ask you the question, okay, I'm planning for retirement here, I've got an eye on my income, but also cash flow, which is more important? Which should I pay more attention to and why?
Well, it really comes down to what you keep is all that matters. If you've got really good income and, a really high tax bracket and you still have a mortgage at 7% on your house and you didn't refinance when the mortgage was lower, you just bought it recently, how much is that eating into, that big fat income that you're getting? And the other thing is if you have a high income, then you have to pay taxes at a higher level on more of your Social Security. You have to pay higher premiums for your Medicare, called IRMA, the income adjusted Medicare payments. So you have to consider all those things, that what a higher income really does. What is the net that you get to live on? And, when we do an income plan, that's really all that matters is, okay, what is the realistic income or a realistic amount we can spend? And sometimes it means if we're not going to take a lot of risk with our money because we're a little more conservative now that we retired, maybe you don't want that 7% mortgage. Maybe you'd rather make 5%, or maybe you'd rather take, because you're making only 4 or 5% on the cash, and you have enough, maybe you should pay that off. Now, I wouldn't recommend necessarily taking a whole bunch of money out of an IRA to pay off a $500,000 mortgage, or you're going to have a $200,000 tax bill. That's not going to be smart either. Then where do you get that money? You take it out of your IRA and then you have another $60,000 tax bill. So it's a compounding problem. So you want to make sure that you look at, all the angles. What should you pay off? What payments should you get rid of? It really comes down to, are my expenses less than what my monthly mailbox money is? Those checks that are coming into, I call it mailbox money, but it's really just, what are getting deposited in my bank every month? How much of my investments do I have to draw down in order to keep my lifestyle at a place where I enjoy it? And will that money last as long as I do or as long as I need it to? Those are all interesting and very important questions, and you need to ask yourself those things. But some people, I want to guarantee all my income. Yeah, well, if it pushes you into a new tax bracket, it might end up costing you more to be there than it would be doing a little bit more conservative nature, getting a little bit more guaranteed income and keeping yourself just right under the next tax bracket for the remainder of your life, rather than going into a position where you have to pay more taxes and end up losing a lot of your investments and future cash that you could have spent.
Talking with Jeff Hogan here of Premier Retirement Planning and Wealth Management in Tucson and Mesa. Once again, our telephone number, 520-780-9059. If you'd like to get in and sit down and talk with Jeff about your journey towards a confident retirement, we're offering this retirement roadmap, no cost and no obligation for that, 520-780-9059. Jeff, we talk about this retirement roadmap all the time that we offer here by calling 520-780-9059. For the next few minutes, Jeff, can you sort of give us a nutshell of what that retirement roadmap review, this beginning conversation, looks like?
When we talk about the 5 pillars of planning, we talk about how you're invested now, discuss your risk tolerance. We also need to discuss how much of those funds need to be converted to an income stream, either a predictable income stream or a guaranteed income stream. If you've got tons of guaranteed income streams and you just want a predictable extra amount, then, you can be a little bit less forced into I got to be conservative and got to guarantee this income. You've got more options that way. Bottom line is you've got many different ways to invest your money besides stocks, bonds, and cash. It doesn't have to just be the Wall Street methods. There's insurance products that are really built for retirement planning, and people are in higher numbers as I go, I'm in this business longer and longer, higher numbers are getting savvy to the idea that there's more than just Wall Street, especially after the fact. And I think it's because, they've seen the market go up and down so big in the last 20 years, a couple of different times, that they don't want to be caught in the next down swoop and lose a portion of their retirement. So we talk about the income. How much do we need to, take off the table? It's time to take profits, or is it time to let it grow a little longer? How long do you have to retire? What's your tax problem going to be, as opposed to, and what is your tax problem right now? Do you have a tax problem right now? Maybe it's wise to get a tax problem right now. Why would I say that? Well, it might be smart to have a tax problem now so you don't have a tax problem the rest of your life, because sometimes you can be so good at kicking that can down the road that it's only a few more years that you have a good palatable tax bracket, and then all of a sudden you're in one that you can't ever get out of for the rest of your life because you save too much in 401ks and IRAs, and you you look for too many deductions currently when you should have actually been converting to Roths or taking some of that IRA money or what you were putting into the 401k that was already big enough to cause you a tax problem, maybe into something that was more tax advantaged, like a LERP or like some sort of an annuity that guaranteed you a set rate of income that you would know exactly how much is taxable and how much isn't taxable so that you could look forward and actually have a crystal ball into the future as to what your tax situation would be. Most people just hold and hope and figure it out a year at a time and say, oh, well, I've paid a lot of taxes because I made a lot of money. Well, I guess that's good. Well, you could equalize your income on a level where it would also equalize your your taxable income and your spendable income. Most people, I think, live a lot longer if they don't have the stress of, oh my gosh, I could run out of money. I hope the market doesn't crash tomorrow. I've got so much at risk. And if you wake up every day scared because you've got scared money in the market and you're scared to lose it, I think that's going to be life altering, not just life expectancy altering, but you're not going to enjoy your vacations. You're not going to enjoy your time getting out of bed and doing your fun retirement stuff. Again, buy some peace of mind with that stuff. And, part of that is are you investing too risky? Do you have an income plan set up? Is that income plan tax friendly? Or are you going to be ticked off because you have to write big fat checks to the IRS forever? The biggest problem or the biggest expense in retirement for the majority, if not all of my clients, is really taxes. Taxes are going to be the biggest expense. The second biggest expense is typically long-term care or some health issue that isn't covered by Medicare. And typically that includes nursing homes and, assisted living, some of those convalescent care that you get just by aging, but isn't a serious enough medical condition that you need a doctor or surgery for. So, how are you going to pay for those bills? The average person is going to pay over $300,000 in medical care from age of retirement, mid-60s to 90 or whatever it is they live to. How are you going to pay that $300,000? Are you self-insured? Do you have enough saved to do that? Do you have insurance? Maybe you've got a life insurance plan that'll allow you to access extra death benefit early so you can pay for that care. That's why we like LERPs, life insurance retirement plans, where you can borrow against your death benefit all during your life. And then if there's some final days where you need access to the rest of it or all the death benefit, you can get about 95% of it out to use either on a terminal illness basis. You don't have to die to collect your death benefit. You can actually collect it while you're alive and cover it that way. And then the final pillar, of course, is the estate plan. Do you have a will or a trust? How are you going to give the stuff you leave behind to who you want and how you want with the least amount of trouble and taxes? It's a comprehensive plan. It starts out just with a conversation and we hone in on each part as they come up. But in the end, you should have the peace of mind knowing that going forward is going to be a lot easier than just a hold and hope method.
Jeff, hate to cut you off, but we're running out of time quickly here. 520-780-9059 is our telephone number if you'd like to have that conversation with Jeff. Out of time for this week. Jeff, thank you for your time, but most importantly, I want to thank our fine listeners here in the greater Tucson area for joining us. For Jeff Hogan, I'm Jeff Shade. Have a great weekend. Talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.